So what we're really focused on for this quarter is what's happening with credit. We're expecting very big provisions, probably larger than they were in the first quarter. Then we're expecting provisions in the second half of the year to decline. We're expecting headwinds on revenue just because interest rates are down. We're expecting margins and net interest income to be down. But there are going to be some banks who do better than others. And the banks that start reporting on Tuesday, in particular JP Morgan and Citi, who have really excellent securities operations, those who have investment banking along the lines of sales and trading, capital raising are going to do well. And those with mortgage businesses we think are going to do better.
To that end, Tom, I mean, there was $190 billion of new stock issued recently. A lot of regional banks will see benefit on fees from the Paycheck Protection Program. How bright do you think some of those bright spots will be? And do you think that it'll be enough for investors to hang their hat on?
Here's the story. The size of the provisions are going to be really big, and I would recommend investors put their seatbelts on. They're going to see very big provisions, and it's probably going to make folks and investors nervous. However, like I said, that's because of the accounting that's involved. We believe that once we get past this moment, we only have 2 banks of our 24 banks in the Keefe Bank Index that we think are going to lose money this year. We think the second quarter will be the toughest quarter. It'll get better as the rest of the year plays out. We think that 70% of the banks will earn their dividends this quarter. So bank stocks coming into this, we're trading around 160 of tangible book. Today, you can find plenty of regional banks trading at 90% of tangible book. I think the question is how much of this challenging headwinds that you just mentioned are already in the stocks. We think these stocks are really pricing in a lot of uncertainty, and we need to get through the second quarter and into the second half, I think, for investors to see, I think, better performance.
Tom, I wonder if you think, if the provisions are that big, can it be accompanied by some reassurance that they won't be as big in the subsequent quarter?
That is really important. And so JP Morgan traditionally kicks everything off. I'd say I think that Jamie's conference calls were one of the most widely listened to in the market. And also, too, this is new. We've never had this accounting for CECL. We've never had government stimulus like this. And thankfully, global pandemics don't happen often. So and we've never shut down the economy purposefully and then restarted it. So hearing the color from Jamie and other managements is going to be really important. What I hear from CEOs is that they do see green shoots. They do see cash in their clients' accounts. And so it makes them feel better, but no one will feel really good until you actually see it play out. And then the other thing, too, Carl, is I think one of the big stories of the last couple of weeks is the banks did pass the stress test, I think, really well. And the Fed at the last minute heaped in even another dose of conservatism. So the balance sheets are strong. This is an earnings issue for the vast majority of the banks. And we want to listen to what the tone is from managements in the quarter.
Tom, I'm listening to you, and I get it all, in terms of the balance sheets, in terms of sort of where things stand. But what I wonder is what's going to actually change the sentiment on the stocks themselves. I mean, the biggest 4 banks, are down anywhere between 30 and 50% in the case of Wells Fargo. What changes that?
Well, it's very interesting. And believe me, that's the majority of the conversation we have in our research department and on our trading desks at the firm. Believe me, we're talking about it all the time because most of our target prices are 30% higher than current stocks. So a couple things in my experience. It's hard to have stocks rally when there still is perceived bad or challenging news that's coming out. There's no way you can say the second quarter is going to be a good quarter because the provisions are very big and returns are going to be very low. I think you actually have to see it play out. And if you were to say, Tom, what's the beacon to look for? We're modeling 2022. And we've done a sensitivity analysis. I've heard your comments about the Biden tax plan. We factored it all in. If you look at these stocks and if our models are anywhere near being right for 2022, we get through the trough of performance, which I think is going to happen in the next 6 months. You can make a lot of money in these stocks, but the uncertainty is high. And I think that's what's fearful to investors. And then the last piece is growth is just crushing value. And that trade is happening hard in the market, and banks are smack in the middle of that. And I think that's also driving the momentum has just been so poor.
Right. But when it comes to the actual back to the balance sheets, I mean, again, we can go through the quarter, and I've talked about it earlier. M&A slow, but debt and equity capital markets excellent. Trading, one would imagine, very strong. But back to the balance sheet for a second, Tom. I mean, what would it take for you to revisit your somewhat optimistic views in terms of the bank's ability to withstand this economic downturn?
We need to see what happens. I think that the mile markers are, we need to see what happens when the deferrals stop. And when clients of banks are expected to start making their payments again, I think if that kicks in, that is a key catalyst for the group. And right now, there's just a little bit too much uncertainty, even though there are expectations that what we've been seeing so far is more of these deferrals are voluntarily paying even before the deferral period is over. We need to get through that moment. And I think that's when you start to see things happen. Because remember, too, before COVID, banks were returning 100% of their earnings in capital return, either in dividends or in share repurchase. Share repurchase has been shut down. Dividends are a little bit more in question because of the Fed policy. If we get through the credit, then I think you'll see those things come back. And I think that's when the stocks probably start to work.